Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here, once again with the rundown with Rob and Rich, where we take you into happy hour every Friday by running through the week that was in the mortgage industry. And
So Rich, in other words, we're standing between people on this crowd and happy hour. Look, Anders is already lashing into me.
I would say
Anders.
Happy hour starting early for maybe a lot in our industry as of late, not just on Fridays, but so Mr. Zandi. Good to see you, Mark. How's it going?
Mark is muted.
Very good. I'm very good. Good to see you guys.
Mark, where do you call home?
I live in suburban Philly. This is,
okay.
This is where I grew up. My kids say I've sheltered in place all my life. So,
okay, we'll refrain from any James Harden questions then. That's questions on the economy might be easier.
You know, I haven't been following. What's the story with him? Is he?
It's just that he's just the mercurial star that can never seem to kind of get it all together. But
yeah.
Well, happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. And as always, pleased to be joined by my esteemed colleague and co-host, who is somewhere in the Pacific Islands, evidently, Rob Chrisman. Rob, good to see you. And your background, I'm completely envious.
This is a fake background, Rich. But before you introduce my son, I will say that I am in Fiji, which I did a little comparison before the show, and I know we want to get to Mark as soon as possible, but you think, oh, Fiji is far away. Fiji, if you were to travel, Rich, from your hometown of Twinsburg near Cleveland to Salt Lake City, that is the same distance as Fiji is to New Zealand, to keep things in perspective. Okay. So Fiji's down near New Zealand, and it's it's near the equator. It's very temperate, and having a good time here. It's nice.
Excellent. Where else are you going to get information like that? So, Rob, thanks for the update. And Rob's irresponsible millennial son, Robbie, once again checking in, not from a casino. What are you in, like suspended in midair, or what?
I think fake backgrounds run in the Chrisman family, like father, like son.
Oh, we're both looking at the Pacific Ocean, Rich. We both have the Pacific Ocean in the background. It's very interesting.
As always, I have my boring Twinsburg, Ohio office background, but
see, like the Christmas lights. When do the Christmas lights go up?
Well, it's almost Christmas season again, so it's that's the beauty of keeping them up all year. It's you don't gotta put them up in the fall. So, and this week, a real expert on the show. We are really thrilled this week to have a guy that is an advisor to policymakers, really influential source of economic analysis. Testified before Congress. He's constantly on the cable news programs. The chief economist for Moody's Analytics, Mark Zandi. Mark, really happy you're able to join us.
Yeah, thanks for the opportunity. It's good to be with you guys. I wish I were in Fiji. I've never been to Fiji. It looks like a place one ought to visit, though. It looks great.
Very nice. People are very nice. It's a good place to visit.
Yeah.
We've been talking so much about the broader economy on this show. Obviously, inflation, the broader economy's impact on housing and Fed action and mortgage rates is driving really everything with our business. So, wanted to reach out to Mark, good friend of TMC, to get his take on what's going on with the U.S. economy, the housing market within it, and provide some insight to our members. So, Mark, thanks again for joining us, and really looking forward to the conversation.
Yeah, again, thanks for the opportunity. I'm looking forward to the conversation. Thank you.
Beautiful. Let's get into it. As everybody should know by now, strive for interactivity with the show. I already see some stuff coming in the chat, Q&A. If you're listening on podcast, where the majority of you listen, join our live broadcast Fridays at 3 on Zoom. You can go to mortgagecollaborative.com to register live for that. Rob, so this week, kind of a crazy week just for the markets in general. This morning, the CEO of FedEx came out and predicted a global recession, obviously freaked out the markets. FedEx missed bad on earnings. They withdraw their full year guidance. They announced all these cost cutting, and the CEO spoke to what he called a significantly worsened global economy. This, of course, coming off the heels of Tuesday's hotter than expected inflation data. And you can kind of predict, what has happened with the market since. Stock market's just totally gone in the tank. Bonds have sold off the inflation data, kind of sideways today. But your take on the current market environment?
The last time I checked here in Fiji, a recession leads to lower rates. Is that the case in the United States, Rich? I don't know. You have to be careful what you wish for. And I think a lot of loan officers who write to me, they'll ask, when are rates going back down? When are rates going to go back down? And I remind them, what is going to cause rates to go back down? Mr. or Miss Loan Officer, do you really want a recession to push rates down? Because then you start running into qualification issues, you start running into delinquency issues, possibly even with all the equity that homeowners have out there. But I think and Mark, I'm sure you're going to get into this, the psychology has certainly changed in the last several months. And at some point, anyone predicting a recession would be, sorry about the bird, the fake tiki room bird noise here in the background. But, at some point, everybody who predicts an expansion is going to be right. Everybody who predicts a recession is going to be correct. And right now, the psychology is such that it seems like it's almost self-fulfilling in terms of, gee, if there's going to be a recession, we better do this, we better do that, we better not, we better start to hunker down ahead of holidays. Summer vacation season is over with for the most part, so it's time just to maybe not spend as much money, and so it almost feeds upon itself. But I mean, that leads right into Mark and what you're seeing out there in terms of the overall economy. Is that what you're seeing, or do I have it all wrong?
Well, no, the economy depends on which part of the elephant you're touching, right? I mean, if you're looking at the job market, things are rip roaring. We're creating lots of jobs, 300K plus in August, 400K on average over the past 6 months, 500K on average over the past 12 months. And just for context, we need about 100K to absorb the trend growth in the labor force and keep unemployment from rising. So, unemployment's falling. Layoffs are at record lows. There's some high profile layoff announcements. I saw Goldman, Tesla, some tech companies, but in aggregate, they're about as low as they've ever been. Record number of open job positions. So from that prism, from that part of the elephant, it feels pretty good, at least at this point. But obviously the problem is inflation. It's very high. It's got to come in, and the Fed's on the warpath and raising rates, and will continue to raise rates until inflation comes in. And in that environment, recession risks are high, and the probability of going into recession at some point over the next 12, 18 months are considerable.
Right now,
Yeah,
go ahead.
like I said, and that's a great analogy. It depends on which part of the elephant you're touching, because you're right, the job market is doing incredibly well, and there continue to be help wanted signs, it seems like, in storefronts, especially in the service sector of the economy. And in terms of mortgage banking, I'm sure, Mark, I mean, I think people send me layoff notices all week long, and either Robbie handles them or I handle them. And I tell people, the headline news is actually any company that is hiring or any company that is not laying off in mortgage banking. It's certainly a cyclical business, and we're being reminded of that right now. But in terms of the U.S. economy, yeah, jobs and housing. And right now, jobs are still doing well despite some of these headline layoffs. Housing, there continue to be these headlines about, housing prices falling or housing price appreciation, plummeting. And Mark, I don't know, I'm sure you watch the show regularly every Friday, but I try to remind people that to read past the headlines. And just because housing price appreciation, is 20% a year for the last 2 years, and now goes down to 2 or 3% a year, I don't think that's necessarily a bad thing. So my 2 cents.
Well, yeah. Well, I agree. Things had to cool off, right? Because at the pace of house price growth, things were becoming completely unaffordable, and right now they are at these mortgage rates. 6% mortgage rates conflate with these high house prices, and it's unaffordable for the potential first time home buyer. I mean, just give you a statistic. If you're the household making the median income, which is about 70K a year, and you're looking to buy the median priced home, which is about 400K a year, to say you put 20% down, which would be a challenge for a lot of first time buyers, but let's just say their monthly mortgage payment is going to be almost $2,000. And that's up from $1,300 a year ago when mortgage rates were at record lows. That's a $700 per month increase in payment. That's just that's not happening. So first time home buyers are to the sideline. So we are starting to see some price weakness, and I do expect we will see some price declines here over the next few quarters, really over the next couple of years as things adjust and affordability is reestablished. So in that sense, it was inevitable, right? Because housing was just becoming out of reach for many potential homeowners.
Yeah, especially at the higher price points. I mean, you would, in the San Francisco Bay Area, for example, or Manhattan, you'd hear some of these outlandish prices for small, 1 bedroom or 2 bedroom units, or nice properties within driving distance of a metropolitan area that were, just flabbergasted. But I'm continuing to hear that, in certain areas, prices or housing that's anything less than $200,000 or $300,000, $400,000 is still flying off the shelf, not staying on the market very long at all. But yeah, certainly the multi-million-dollar places are languishing and definitely due for a correction.
Well, is that right? I'm not hearing that. I'm seeing weakness across the board. I mean, home sales, new and existing. I don't think it's too strong to say they've collapsed. If you look at the July home sales data, we're back to where we were kind of just coming out of the crash a little over a decade ago. That's the first time home buyer that's evaporated. The trade up buyer is, locked in because they have a mortgage at 3.5% because they refied down and they're not going to be able to sell and buy at a 6% mortgage rate. And then you have all those investors, which were a big part of the market before things started to move south. Back in the second quarter, they accounted for about a fifth of all home sales. They've gone completely to the sidelines. Obviously, they're opportunistic and sense prices are going to decline. So I don't know. To me, this market feels like it's weak and it's going to get a lot weaker, and house prices are going to fall pretty significantly here over the course of the next year or two.
This is the rundown with Rob and Rich. And for those that just joined us, really pleased this week to have Chief Economist for Moody's Analytics, Mark Zandi, with us, in addition to Rob Krisman and his son, Robbie. And Mark, you also, you just wrote a piece. It was on getting back to the inflation piece, student loan forgiveness. I've commented on this show a couple of times that I questioned the timing of it because of inflation right now and the sensitivity of it getting worse. And forgiving $10,000, I could like Robbie is an irresponsible millennial. I can tell you right now, if we forgive his student loan debt, he's going to immediately spend all of it. But you did a piece and said it would almost kind of be like a wash. If you could go into that a little further, because I read the piece, but it made me feel better, and it was a fascinating read. So if you could explain just a little bit this legislation and its potential impact on inflation.
Yeah, it's not a commentary on whether this is a good plan, a bad plan. All I was making the point was, if you can either, a lot of people like it, some people really hate it, but that shouldn't be based on whether it's going to add or subtract from growth and inflation. And in that regard, the debt forgiveness part of the plan, all else being equal, would lift consumer spending. Right, the borrowers don't have to pay that debt, as you say, that they're going to go out and spend more because they're just less indebted. That juices up growth and is inflationary all by itself. But also part of the plan is student loan borrowers who weren't paying on their debt because of the moratorium that was put in place, when the pandemic first hit, they now will have to start paying again at the start of next year, if everything sticks to script. And that cuts into purchasing power, spending, economic growth, and inflation. And if you net those headwinds and tailwinds out, It's neither here nor there with regard to the economy and inflation, certainly not for 2023. There's a lot of effects longer run, some positive, some negative on the economy. But, in the near term, you can hate this thing, you can like this thing, but I don't think that revolves around what kind of impact it has on the broader macro economy. It's neither here nor there from that respect.
So let's ask Robbie, although he's been out of school for several years. Robbie, do you have friends who talk about student student loan forgiveness? If so, what do you think they might do about it? Or are they changing their spending because of it?
I think it's a little taboo to talk about unless you directly ask someone. $10,000 is $10,000, and I do think it will goose the economy, especially with millennials tending to spend irresponsibly, like myself, as Rich loves to point out, at every opportunity he gets.
And then Mark, you also, so let's talk going back to home value. So, and this is what we've been talking about in this show. Like, at some point, there's too much underlying demand to buy housing in America for a crash. But let's just look at it ballpark using Case-Shiller. Since the beginning of the pandemic, roughly 2.5 years, home prices on average nationally up about 40% in the last 2.5 years. You look at history, you adjust it for everything you got to adjust it for, about 3% annually, historically, correct, to home value. So we make 40% on home values the last 2.5 years. You said that there's still weakness, and and we're not going to ballpark. Like, how do you see like the next year or so playing out with values of homes?
We're going down.
Like incrementally slow. Like I think we were down 0.8% from, it was July to August, I want to say. That level of declination, or
well, that's a pretty big decline, right? If you annualize that, that's a 10% decline. That feels it feels like the market kind of froze, for a second, for a month, when when mortgage rates jumped, these big increases, and everyone says, oh my gosh, what's going on? Maybe they'll come back, maybe mortgage rates will come back in. So everything kind of froze, and we saw this big adjustment. So I suspect we're not going to see monthly price declines on that order of magnitude for very long. That would then quickly turn into a crash. And I agree with you. There's good reasons to believe that's not going to happen. But if you told me national house prices are down, from their peak in the second quarter, a couple of years from now at their bottom, somewhere between 5 and 10%, I say that sounds about right to me. That's nationwide. And that means, some markets are going to be down double digit, particularly the ones that got most juiced in the boom times, in the Southeast and in the Mountain West, because those are markets that are more unaffordable at these mortgage rates. And also those markets got, juiced by investors. And some of the markets, the more high flying markets like a Phoenix or an Atlanta, got juiced by flippers. Flippers were starting to come back. And these are investors that, come in with the intention of buying and selling very quickly to try to make a quick buck. And they're getting wrung out here pretty quickly. So in those markets, we'll see some significant double digit declines, but nationwide, I'd say 5-10%. One caveat, that's based on no recession. If there's no recession, if we don't lose jobs, if we go into recession because the rate hikes undermine the economy, and the sentiment that we were talking about gets undermined, and we go in and we have a higher unemployment, then I think price declines nationwide that are in the double digits, that seems perfectly reasonable to me. Something on that order, right, that order of magnitude. Still not a crash in my nomenclature. I mean, for me, a crash is what happened back in 08, 09, 2010, all the way through 2011. And that's when national house prices fell 20 to 30%, depending on which index you use, the FHFA or the Case-Shiller. It was 20% on the FHFA. It was 30%, 25-30% based on the Case-Shiller.
Good stuff. Excellent. We're having a lot of great questions come in the chat, in the Q&A. I'll try to get to as many of these as we can. Mark, first one question: if existing homeowners will not sell because of rates and builders are holding off on starts or completing work in progress, where is the flood of inventory going to come from to reverse the supply imbalance and drive down prices? Good question from Paul.
Yeah, I think that's a reason why they don't crash. I don't think that's a reason why they don't fall in price. That just means fewer transactions, but those transactions are going to transact at a lower price. So the actual measured price declines will show up. It's just, you're just going to see a lot fewer transactions. But that is a good reason why we don't see a collapse in pricing. We have a proverbial, because given the low vacancy rate across the housing stock, the market is very tight from a physical perspective, both in the rental side of the market, but also in the for home ownership side. I think that's a good reason to think that prices, there's a floor under prices. We're not going to go blow through it. The other thing I'd point out is that gives me some solace that we're not going to see prices crash is mortgage underwriting has been very good since the financial crisis. It's if you look at the scores, they're all very high, and it's all plain vanilla 30-year, 15-year mortgage. Nothing really wacko like a 2-year subprime ARM or a neg am loan. The things that kind of infected the market, back in the housing bubble that exacerbated problems when we got into the financial crisis, and you got a lot of foreclosure and distress sales, and the price declines kind of fed on each other. I just don't see that happening this go around.
CoreLogic also reported this week mortgage fraud risk down 7.5% year over year to near its lowest levels in history. So yeah, to Mark's point, we're making good loans, we're underwriting loans responsibly. Fraud is drastically been decreased, even in this kind of, I know there's not a ton of business, but it's a purchase only market typically where you see more of that. So
how do they measure that? Do you know? How do they, that's interesting. I hadn't heard that. Do you know how they measure that?
Yeah, it was in the second quarter of 22, an estimated 0.76 of all mortgage applications contain fraud.
Oh, okay.
By comparison, it's down from last year. It doesn't say exactly, what the definition of fraud is, but CoreLogic, pretty massive provider and data warehouser.
It's like the definition of pornography. I can't define it, but I know it when I see it.
Yeah, maybe probably true. Yeah, they must have some algorithm though, right? Because they could.
Yeah, I'm sure that they have some sort of algorithm, but some other questions that have come in related to the home builder side of our business. Mark, what's the outlook for home builders, and what part of the home builder price index increase over the years is due to the GSEs and their subsidized access to the capital markets?
Yeah, I don't think it's about the GSEs. I don't think that's what's going on here. I mean, I do think we will see some weakness in single family construction. Multifamily construction, no problem. I mean, there's so much demand, and with the lack of affordability in the single family market, no first time home buyers, they're all going to be renting. So I see, significant multifamily demand in construction, and we need a lot more supply. On the single family side, there's going to be some adjustment, some modest decline. We've already seen it in terms of housing, single family housing starts. That's because the builders are, a little bit panicked because sales have collapsed on the new home side, and they're now discounting pricing pretty aggressively, kind of trying to figure out where the market is. But I do sense that, we, as I said earlier, vacancy rates are very low across the housing stock, and for home ownership, they're at record lows. So I don't think we're going to see big declines in construction, single family construction here. So if I kind of rank order, when I think about the housing market, I think supply, demand, price. The thing that's going to get hit most is demand. That's sales, or they've collapsed. Supply, that should hold up reasonably well. Price somewhere in between, to equilibrate the decline in supply and demand.
Mark, what do you think the federal government, nobody's really talked about some way to incentivize home builders to build smaller homes. Here's the simplistic way I look at the world.
Yeah.
There is not nearly enough housing supply. I feel like the pandemic has, in general, made home ownership and where you live more important to people. And you just have this dearth, nothing. This is a problem that takes years to fix, even if you have the right solutions, because of how long it takes to build homes. Nothing at all is being done. Like, the simplistic way I look at the world is this is heading towards a major problem.
Not heading. We're there. We got a major problem. You can see it. Take a look at rent growth. I mean, that's one of the reasons why we have such high inflation, is because we have no rental property, no homes. So, it's difficult for the federal government to enter in, because a lot of these are, zoning, permitting. Those are local issues, state and local issues. There's no easy entry point. But if I were king for the day, I'd focus on, affordable rental, LIHTC, that's tried and true. And, there's a lot of bipartisan support for that kind of approach. New market tax credits, There's a new neighborhood home tax credit for renovation that would help out in urban areas. And then if I had a little bit, if I was king for a week or a month, then I'd probably focus on, there's where I go to the GSEs and I'd say, hey, let's build out a secondary market for manufactured housing and accessory dwelling units, ADUs. And that's truly affordable single family. And the problem in those markets is there is no secondary market for those chattel loans that support the manufactured housing. And there's no standardization. That's what Fannie and Freddie did. They standardized the mortgage market and brought down costs for everybody, particularly middle low income households. And I think they should focus their attention on manufactured housing. And that's very, very popular, or at least historically, it's been very popular in the South and the West. And that's where the shortages of housing are most pronounced. And then, the obvious thing that really would help the broader economy and housing on every level is immigration. We need more immigrants coming into the country, skilled and unskilled. That would be critical, because a lot of the problems in the building trades is they can't get workers, particularly again in the South and the West, where the demand for this is strongest. So that would go a long way, I think, to helping the economy, its labor supply issues, getting inflation down, and directly benefiting the housing market and supply.
It's a great point.
Obviously, that's Mark, we deal with a lot of lenders, and the Mortgage Collaborative has a lot of lender members, and non-QM has been a big topic. And when you talk about Fannie Mae and Freddie Mac, obviously standardizing a lot of lending policies and procedures and underwriting guidelines, and really tapping into the secondary markets, I think the industry has a very cautious eye, especially after First Guarantee and Sprout left the industry, about the non-QM industry, and the fact that guidelines are not quite standardized. The secondary markets aren't quite standardized in terms of the production that gets issued. So you have a lot of lenders out there trying to address that by having more than just one outlet for a given loan. And sometimes that's a real hurdle for capital markets teams, is trying to find two investors for the same loan that's underwritten on the same guidelines, this has the same criteria. It can be very difficult. And I think like I said, a lot of lenders out there are very nervous about the non-QM segment of the industry for that reason.
Yeah, well, by definition, the GSEs don't play in the non-QM space, right?
Right.
So, they're not going to standardize that market. That's a private market. Have at it. The share of the market that's non-QM, correct me if I'm wrong, is probably about 25% ish. Something like that. Lower? Is it lower than that?
I thought it was five or 10.
Oh, wait, I mean, I should say the non-conform, the non-government part of the market is 25. You're right. The actual non-QM is probably, closer to 5. Yeah.
Yeah.
Mhm. Yeah.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob and Robbie Krisman. And this week, the chief economist from Moody's Analytics, Mark Zandi. Mark, Rob, you have a question?
I do have a question for Mark. So
That's very polite.
well, so my question is, you work for Moody's, and when you go back, and this is probably weren't expecting this question, you don't have to answer.
Far away. No, go ahead.
So coming out of the financial crisis, whatever you want to call it, 2008, 2009, 2010, the rating agencies were mentioned, obviously, in terms of being part of the problem. There was so much blame to go around. Call it the borrowers, call it the brokers, call it the lenders, call it the investors, call it, there was plenty of blame to go around. But the rating agencies were dragged into that to some extent. Can you tell folks on the call here what the rating agency, and maybe you can just address Moody's, have done to kind of right the ship, if the ship was indeed listing, if there were issues back then? What has happened with rating agencies to give capital markets investors greater comfort that the rating agencies aren't going down that path again?
Yeah,
if there was a path that they went down.
Yeah, and you should know, I had my own firm and I sold it to Moody's back right before the crisis hit, a little over 15 years ago. So and I'm not part of the rating agency. Moody's Analytics is a separate independent company within the Moody's umbrella. So we're separate from the rating agency. But having said that, I think it's pretty clear that, they got it wrong. The ratings were just dead wrong on the mortgage securities that were issued. And that did contribute to the problems that ultimately happened. Investors took those ratings as gospel, didn't do their own due diligence in many regards, and paid a price. We all paid a price for that. But the biggest change between now and then was back then the rating agencies would take the information provided by the securitizers, the investment banks and lenders, at face value. They did not vet in any way the information, the income, the loan to value ratio, or the appraisal, the credit score. It just came on a file and they took it as given. And that going back to fraud, there was a boatload of fraud going on at that point in time. And so by so doing, that fraud just was perpetuated, the loans got originated and they got securitized and got into the marketplace. And that was a mistake, a huge mistake. But now in the post-crisis era with financial regulatory reform, the agencies are required to do their own vetting. So they do, I'm not precisely sure how they do it, but my sense is they do randomized sample of loan files and check to see, that everything squares. Of course, the other thing that makes this a lot easier these days is, the rating agencies really aren't rating very much mortgage securities, right? Because as you pointed out, the non-government part of the market, the non-Ginnie, the non-GSE part of the market is pretty small, and not getting securitized. So it's not nearly as important as it was back in the day. And I don't think that securitization market's ever going to come back, at least not in my lifetime, because of the CRT market, the credit risk transfer market. So if I'm an investor globally and I want to take credit risk, I'm not going to take it through a mortgage-backed security, a non-government backed MBS. I'm going to take it in some form of CRT, the risk transfers that the MI companies are doing, or private mortgage insurers are doing, or the GSEs are doing, that kind of thing.
Some questions that have funneled into the chat and the Q&A. We got about 10 minutes left with Mark. If anybody has any final questions, a couple intertwined questions, Mark, that just speak to really like August 1. We got some bad inflation data, rates shot up. It was already a bad year for the mortgage industry, but it led to this, in the question, a hopeless feeling. And the question is, Mark, can you give us your opinion of any light at the end of the tunnel? It's hard to see hope of things getting better. A similar question about like rates. Have they peaked yet, in your opinion? If not, when? Any crystal ball stuff for us that's positive? If not, just lie.
Yeah, that sounds pretty lugubrious. That's a pretty, pretty dark kind of question. Okay, I can take the other side of that. Well, first let me say, so don't sound Pollyannish. Obviously, we're in a very tricky time. Inflation's high. The Fed's going to get that inflation, and if they have to push us into recession to do that, they're going to do it. So this is going to be uncomfortable under any scenario. It's going to be an uncomfortable 12, 18, maybe 24 months, something like that. But having said that, let me point out that the underlying fundamentals of the economy are actually pretty good. Take the American consumer. I mean, low, lots of jobs, low unemployment, lots of cash, barring the folks at the very bottom of the income distribution that, blown through the cash because of the high inflation, high middle income households, high income households. If you look at what they got in the checking account, it's pretty significant. And that goes back to sheltering in place and not spending. And of course, the government support for the middle income households. And that provides a nice cushion to navigate through. Debt is low, leverage is low. Debt service is about as low as it's ever been in the data. Households have locked in, these low rates through refinancing ways. The average coupon, I think I mentioned, on an outstanding mortgage is 3.5%. That's 30 year, 15 years locked in. Stock prices are down, 20%. Even, I haven't looked today, but even, they're down 20%. But house prices year over year, they've risen, 15, 20%. They net out right now people are as wealthy as they were a year ago. They're wealthier, much wealthier than they were 3 years ago, 5 years ago, 10 years ago. So, you add it all up, I think the American consumer, broadly speaking, I'm painting with a broad brush, and there's a lot of differences here across the income distribution, are in a pretty good shape. The financial system is in fantastic shape. There's capital everywhere, liquidity, underwriting's been very good. The real estate market, the housing market is undersupplied. Generally it's oversupplied. You got way too many vacant homes out there. That's the opposite that we have right now. State and local governments are running flush with cash. Their rainy day funds across every state are full. They're as full as they've ever been. They got cash everywhere for lots of different reasons. The corporate sector, take a look at their balance sheet. Their profit margins are extraordinary. They're coming in, but they're coming off record highs. And, they're investing and they're sitting pretty. Their leverage is low. They've done a pretty good job locking in. There's some blemishes, again, I'm painting with a broad brush, but, generally speaking, the only balance sheet in the economy that's got a problem is the federal government's, right? We borrowed a lot of money to help navigate through the pandemic and the financial crisis back a decade ago. But that's a problem, we're still the AAA credit on the planet. Our balance sheet, our federal government's balance sheet is stronger than anyone else's. So if there's a problem anywhere on the planet, money comes flowing in here. So, it's going to be a problem we're going to have to face up to, but not in the near term. So bottom line, our fundamentals are pretty darn good, which argue we don't go into recession, but if we do go into recession, it's a relatively mild recession. So I could give you more reasons for optimism, but, hopefully that will tide you over until the next time we have a conversation.
So Mark, you raised an interesting point. I was talking to somebody recently about the stock market and housing and so forth. And this person, who will remain nameless, said something like, I don't care what the stock market does. I don't have any stocks. And I said, so do you have a retirement plan? Do you have a 401k? Oh yeah. I let somebody else manage that for me, but personally, I don't have any stocks. And I thought, okay, well, that's interesting. But I hearken back to something my mom said about housing, and the price of her house was going up significantly. And I'd say, Mom, look at the value of your house, it's way up. And she said, she would always say, what do you want me to do, Robert? When I was in trouble, Robert, what do you want me to do, Robert? Sell it? You want me to sell? Where am I going to live, Robert? Where am I going to live? It doesn't matter to her. Her house was worth $25,000, which is what they paid for it in 1967. And it didn't matter what housing statistics were doing. She needed a place to live. And I think that's interesting. I think it's important for people to remember that stocks, you don't necessarily need stocks to live, but you do need a roof over your head. And whether you rent or whether you own, I think that fact is lost somewhat in the mainstream press when they talk about housing prices and so forth and so on. I don't think people, I'm not going to put you on the spot, Mark, but I'm not rushing out to sell my house because I think values are going to go down. I need a place to live. In fact, if you look at the folks on this call, I know that many have purchased properties in the last year or two, and they need a place to live. So yeah, values might go down, stocks are going to do what they do, but housing, I'm preaching to the choir here a little bit, but housing is somewhat different because to so many people, it's a home. It's a school district, it's a neighborhood. It's not so much a balance sheet item, even though it is, but treat it a little differently. And I think loan officers continue to see that, and they continue to play to that sentimentality.
Yeah, it's an investment, but it's you consume it, right, every single day, right? I mean, as you point out, you got to live somewhere. So yeah, it's an asset, but it's a special asset because you need to live somewhere for sure. You're absolutely right. Yep.
Mark, you spoke to what you call the sheltering effect. I've seen you write about this as well. And, essentially it was like during the pandemic, people stayed at home, they saved money, they didn't spend as much. They were getting money for doing nothing from the government in different cases. And they, I'm a huge baseball fan. And like the way I look at this Fed is almost like with the way people analyze baseball talent. You have stat people, like advanced stat people. They don't need to be at the ballpark. They just want to look at the numbers. They can tell you everything you need to know. And there's the people that want to, sit in the stands and look at the break on a guy's curveball and how he interacts with other teammates. And this Fed, it feels to me like, was stat guys that, because I think there were some real world implications to this pandemic, all the sheltering stuff you mentioned, that is now causing people to still spend money right into the face of inflation because they paid off debt. Maybe they saved more money. It feels to me like the Fed completely underestimated this with the whole transitory thing last fall. And then, what they're, until recently, they're not as aggressive as it should have been by their own admission action. Any relevance to that analysis, you think?
Well, that's a common view. I mean, I take a more charitable view. I mean, my sense is that the Fed got surprised, reasonably so, by the pandemic and the Russian invasion of Ukraine. I mean, the pandemic, if you go back to the spring, early summer of last year, President Biden gave a speech. I think it was the Freedom Day speech. Go enjoy your families on July 4th. He wasn't wearing a mask. People thought the pandemic was over. It wasn't. The Delta wave hit right away and really was very disruptive to Asia, particularly Southeast Asia, where all the supply chains begin, China, and we saw shortages and vehicle prices go skyward and building materials supply prices go skyward, and that was a surprise. It took them by surprise. And the thing that was even more surprising and probably more damaging than I think people realize was the Russian invasion of Ukraine. And that caused oil prices that were going south, all the way through Thanksgiving of last year. We were down to, $60, $70 a barrel to go skyward. And nothing is more pernicious in terms of overall inflation, and more importantly, inflation expectations, which go to wages and, all the issues we have right now, than higher oil prices. So those two things just, I think, were very serious. They're massive shocks to our economy, supply side shocks. And they were surprises, and they got surprised. And so, they got it wrong, but they got it wrong for reasons that I get. And, I probably would have made a similar mistake. I mean, I do think, there was some evidence earlier this year they should have gotten off the zero lower bound a little bit more quickly, but, that's on the margin, and they're catching up pretty quickly. And at this point, I think they're managing policy well, about as well as one could, given the shocks that they're grappling with.
I mean, the Fed, they need people to stop working and stop spending. Like it's a weird dynamic right now. Like that's what they need, right? I mean, they need.
Yeah, we need to slow down. We need the job market to slow down, and we need wage growth to moderate back to something that is more consistent with that 2% inflation target. So you're right, and that's the point of raising interest rates. So they're in a very difficult spot because they're still dealing with these shocks and the reverberations of those shocks that they have no control over. And thank goodness we didn't get hit by the rail strike. That would be another supply side shock, right? So that's, again, completely out of their control. So they're grappling with some pretty significant issues at the same time, with limited tools, interest rates. That's a very limited. I've got many options here. I can raise them, or how much do I raise them? How fast do I raise them? Over time, trying to address issues that are, just out of their control. So I'm, maybe it's because they're a lot of the chairman Powell's a lawyer. I was going to say because they're economists, I'm cutting them a break, but I just don't feel like they deserve the kind of criticism that they've been getting.
Very fair and well said. Rob, any last follow-up comments, questions for Mark before we take it into the weekend?
Robbie?
I want to know, Mark, we started the show talking about FedEx stock price declining based on the CEO's comments.
Yeah.
In theory, when it comes to the MBS market or equity markets, all future expectations are baked in at present. What sort of timeline is that, though? Does that vary by asset class? How's it weighted from tomorrow? What could happen to a month from now, to a year from now, to 3 years from now?
Well, I think that's an age-old question. I mean, the market, the equity market, the bond market, the financial markets are a discounting mechanism. It's, in theory, it embodies the expectations of investors going forward. Obviously, there's a lot of uncertainty with regard to the future. So it's a distribution of possible outcomes that investors are attaching different probabilities to, but they discount it back to the current point in time. And but it's an imprecise discounting mechanism, and often markets are and this is where they fail. They're not perfect, and they are subject to sentiment and speculation, both on the downside and the upside. So markets can get out of whack. As we see, markets get overvalued, they get undervalued. So it's a discounting mechanism, but an imprecise one, and the timing, it varies considerably. I mean, take the Russian invasion of Ukraine. That came on the radar screen in December of 21. That was starting to show up in global energy markets by December. You could see oil prices starting to move higher, but seemingly didn't get on the radar screen of equity or bond investors until well into February, when Russia actually invaded. So it's a discounting mechanism, but I wouldn't. It's not a perfect discounting mechanism. It's imprecise, and the timing of and how well it does discount future information is varies considerably over time.
A random walk down Wall Street.
There you go.
Good stuff, and great way to take us into the weekend, Mark. Cannot tell you how much we appreciate you coming on the show. This was great. I just really, really appreciate your perspective and getting a chance to talk through this crazy economy and housing market that
I want to thank you, and I just leave you with I strive to be 51% right. So take it for what it's worth.
Good stuff. And once again, many thanks to Mark Zandi, Chief Economist, Moody's Analytics, for joining us on the Rundown with Rob and Rich this week. And many thanks to all our attendees, as always, for joining us. We're every Friday live on Zoom, 3 p.m. Eastern, with the Rundown with Rob and Rich. You can also find us on YouTube, or where most of you listen on podcasts. So Rob, enjoy the rest of your boat trip and safe travels back to the continental US. When does that happen?
Well, I'm a day ahead of all you people, so I already know what happens for the rest of the day.
Oh, who wins the baseball game tonight, so I could bet on them then?
Sorry, you cut out there, Rich. Traveling back across the date line, leave Tuesday night, arrive SFO Tuesday afternoon. So I'm this weekend, Rich, I'm going to do my best to adhere to your advice and not work and not spend money.
There you go.
Continue to eat rice and frozen chicken.
Well, Robbie will pick up your spending, and Robbie, has to be noted, the Browns, Baker Mayfield, a little short, no pun intended, against the Browns this week, with his usual 10 balls batted down, as a new Browns kicker sensation, Cade York, takes the Brownies to 1-0. So I know you gave me some Baker crap last week, so I had to throw that in there. So, are you an Eagles fan, Mark?
I'd say I'm a fair weather fan. Unfortunately, if they're playing well, I'm all in. If they're not, I can't watch. So
they're like they're the sexy chick Super Bowl pick this year.
I know. I mean, it scares the heck out of me. That definitely is not going to happen now, for sure. Yeah. And that's the other thing I do. I set my bar very low, expectations very low, so it's easier to get over them. So I do have tickets for the Eagles Packers right after Christmas, Monday night.
Ooh.
Football. So I'm hoping that we have a good team.
Are the Eagles fans going to boo Santa Claus again as they're
absolutely? Are you kidding me? No, absolutely. Yeah.
And Rich, you should know the Fijian Marlins are supposed to sweep the South Pacific Rugby League this year.
Oh, they're good.
Is there any sports in Fiji? What is it? Water polo?
He's not
rowing? What do they do out there?
It's all about rugby, man. They're good, aren't they?
Rugby.
Yeah, they're good at rugby.
Rugby. And and I've seen some of these rugby players, and they're
massive.
They're not tiny.
Yeah,
with mangled ears. Yeah. So
right, see you later.
All right, guys. Have a great weekend, everyone. We'll see you next Friday. Take care.